Next piece is from the Financial Post, and it says Bank of Canada governor warns of growing risks to financial stability. So Tiff Macklem said, military actions recently, which unless you've literally been living under a rock or have zero social media, military actions in Iran have increased volatility in energy and financial markets. Uncertainty around the duration of the conflict and the potential fallout is, of course, going to create greater global risks for just almost every economy. And, we already have a little bit of a weak economy over here, so any more volatility is probably very unwelcome. Economic uncertainty is already high, said Tiff in a recent speech at the Global Risk Institute in Toronto. We cannot afford to add financial instability to the mix. Well, too bad. It looks like we already have.
Non-bank financial players have now become central in how sovereign debt markets function, both globally and here at home. He said, adding that in Canada, they account for up to 50% of government bonds sold at market and are major players in the secondary market. This adds liquidity and efficiency in good times, but the leveraged sovereign debt purchases pose risks in times of stress. And the scale of these trades and speed at which they can unwind pose systemic risks. It's the first time I've heard him say the word systemic risk in a long time.
It's kind of unnerving to hear this stuff. So, okay, if you're wondering what this kind of means in plain English, because the article goes on and on, basically, the Bank of Canada, TIF, are warning of two growing risks. The first is governments taking on more debt, too much debt, specifically our government. That reduces government's ability to fund big programs and respond to crisis. And private credit lending from non-bank firms and funds has expanded rapidly and, of course, is less regulated. Together, this matters because private lenders now finance a lot of real estate projects and mortgages. And if they suffer losses or feel the need to pull back, financing for builders and buyers could, and we've already seen this, dry up. So slowing construction, making mortgages harder and more expensive to get. At the same time, highly indebted governments like ours would have less ability to step in with support. So a housing or credit shock could hit harder and last longer. That is not great overall.